Welcome to the Deep Dive, where we take all this information, research, articles, notes, and really boil it down for you. Think of it as your fast track to getting informed. Today, we're putting on our TalkTickers hats.
Right.
We're diving into an earnings call, cutting through the jargon to give you the essentials, quick and clear.
Exactly. And today we've got SiriusPoint's Q2 2025 call. They've been making some waves in specialty underwriting.
They really have. So yeah, we'll break down the performance, the strategy, what it all means. Let's kick off with the overall vibe, the sentiment. It felt pretty positive after the call, didn't it?
Oh, definitely. The market seemed to like what it heard. A sense of real progress, I think. Strong performance.
Okay, so let's get into the specifics. What were the headline numbers that really caught your eye?
Well, first off, the underlying EPS, that's the non-GAAP figure, was $0.66. That significantly beat the consensus estimates.
Okay, underlying 0.66 cents. So adjusting for maybe one-offs and things.
Exactly. Gives you a clearer picture of the core operations. Now, the official GAAP number, the standard accounting one, was actually 0.50 cents, which technically missed the $1.56 consensus slightly.
Oh, okay. So the underlying story is stronger.
Much stronger, yeah.
Yeah.
That's where the focus really is. And revenue beat to $748.2 million, also above expectations.
Nice. And for an insurer, the combined ratio is always key.
Absolutely critical. And their core combined ratio came in at 89.5%.
Wow, below 90%. That's impressive.
It really is. Remember, anything under 100% means they're making money on the underwriting itself before investments.
Yeah.
So 89.5% is excellent.
And that low ratio must have boosted profits.
Hugely. Underwriting income hit $67.6 million. That's up 83% year over year. Massive jump.
83%, okay.
And they kept growing the top line too. Gross premiums written up 10% year over year. That's actually their fifth quarter in a row of double-digit growth.
Fifth quarter. Okay, that shows consistency.
It does. And tying it all together, the underlying return on equity, ROE, was 17.0%.
17%. Isn't that above their own target?
It is, yeah. Comfortably above their target range. And maybe the key takeaway, this makes it 11 straight quarters of underwriting profit.
11 quarters.
That's,
Well, that's quite a run in this industry. It suggests something deeper is going on, doesn't it? Not just luck.
couldn't agree more. It points right back to what the CEO, Scott Egan, was saying about their disciplined underwriting strategy.
Right, I saw that quote.
He specifically mentioned that 17% underlying ROE exceeds our 12-15% across cycle target. So they're performing better than their own long-term goals right now.
Which suggests it's not just favorable market conditions, maybe. It's actual strategy working.
Precisely. It implies they're being really careful about the risks they take on, the pricing, not just chasing premiums for growth's sake. It's about profitable growth.
And they seem confident it'll continue. Did they update guidance?
They reaffirmed their full-year guidance, still aiming for that 12-15% underlying ROE range across the cycle, still targeting double-digit growth in core gross written premiums, and importantly, targeting a core combined ratio below 92% for the full year 2025.
So sticking to the plan, it feels like validation, doesn't it?
Absolutely. This quarter wasn't just a blip, it reinforces their whole strategic direction.
Okay, let's dig into that underwriting performance a bit more. That 89.5% combined ratio. What were the components driving that 3.8-point improvement year over year?
A big piece was the attritional loss ratio. That improved by 1.8 points.
And just to remind folks, attritional is.
That's your sort of everyday expected claims,
Yeah.
not the big catastrophes. So an improvement there signals better basic blocking and tackling, better risk selection, better pricing on the core book of business.
And that's sustainable improvement, it sounds like.
Well, this is the sixth quarter in a row they've improved it. So yeah, that was like real sustained operational efficiency, not just a one-off.
Sixth quarter, wow.
Okay. Also helping the numbers this quarter, no catastrophe losses to speak of, which, always ups and definitely contrasts with some prior periods.
Right, that can be a big swing factor.
Definitely. And one more thing on underwriting this was their 17th consecutive quarter of favorable prior year development.
17 quarters. Explain what that means again.
It means they consistently find they set aside more money than needed for claims from previous years. So that excess reserve gets released back into profits now. It's a very strong indicator of prudent reserving.
Yeah.
Being conservative in their estimates. Suggests financial health.
So they're not only managing current risk well, but also proving they assess past risks conservatively. That's reassuring.
Very much so.
Okay, so disciplined underwriting is clearly working, but you need growth too. Let's talk about their growth engines, especially this MGA strategy they emphasize. gross premiums up 10%, but you mentioned net premiums grew even faster in the first half.
Yeah, net premiums written were up 8% in Q2, but 14% for the first half of the year. And that's deliberate. Management said they're choosing to deliberately retain more premiums on our own balance sheet from our MGA partners. So instead of just collecting fees or taking a small slice, they're taking a bigger piece of the profitable business generated through these managing general agents.
Makes sense if they trust the underwriting from those MGAs.
Exactly. And their approach seems very focused. It's about deepening long-term proven relationships. Get this. In Q2, 3 out of the 4 new partnerships they announced were actually expansions with MGAs they already worked with.
So doubling down on what works.
Precisely. And they're incredibly picky. They said they reject over 80% of the MGA opportunities they see.
80% rejection rate. In insurance where growth is often prized, what does that signal?
It signals extreme discipline, right? And probably a very sophisticated way of evaluating potential partners. They're not just adding partners to add premium volume. They're clearly focused on finding partners who align with their profitability goals.
And how does this MGA model help them scale efficiently, maybe without needing huge amounts of capital for each new venture?
Well, that's the beauty of it. They can leverage the MGA's specialized underwriting expertise, their distribution network, while SiriusPoint provides the capital backing and oversight. It lets them enter niche markets or scale up in areas like accident and health or surety, where they saw double-digit growth without putting massive strain on their own balance sheet. It's a capital-light way to grow.
A capital-light growth engine, and it seems to be getting noticed.
Yeah. They mentioned being named Program Insurer of the Year in the U.S., which is, pretty good validation for that MGA strategy.
Definitely a feather in their cap. Okay, let's break it down by segment then. How did insurance and services perform specifically?
That segment looked really strong. Gross written premiums jumped 14% to $560 million in Q2, and the combined ratio there improved significantly, down to 89.3%.
So profitable growth in insurance and services.
Very much so. They highlighted a solid 4-point improvement in the attritional loss ratio, specifically for North American P&C within that segment, so tightening things up effectively.
And what about the reinsurance side?
Reinsurance saw growth too, though more modest. Gross written premiums up 5% to $370 million. The combined ratio there also improved, coming in at 89.8%.
Still below 90%. Impressive for reinsurance. Any specific events impacting that segment?
Well, they did mention a large loss related to an Air India incident impacting attritional losses in Q2. And if you look at the first half, the California wildfires from Q1 had an effect. But the key message was that they've materially decreased catastrophe exposure since 2022.
So a deliberate de-risking there.
Exactly. Trying to make those returns more predictable, less volatile from big cat events.
Makes sense. And we can't forget the investment side of the house. How did that look?
Solid. Net investment income was $68 million for the quarter. They said they're on track for full year guidance there.
And the underlying portfolio? Safe. Risky.
Seems pretty conservative, which is typical for insurers. New money yields are good, over 4.5%. And the portfolio is mostly high-quality fixed income, about 79% fixed income overall, and 97% of that is investment grade. So it's providing a nice, stable income stream to complement the underwriting profits.
Okay, so strong underwriting, solid investments. That should translate to a healthy balance sheet, right? What are the key metrics there?
Yeah, the balance sheet looks robust. Their estimated BSCR ratio, that's the Bermuda Solvency Capital Requirement, is 223%.
And is that good?
Yes, very healthy, firmly within their target range, indicating a strong capital buffer. Also, the debt-to-capital ratio dropped again, down to 24.4%, mostly because shareholder equity grew from retaining those profits.
So less leverage, more equity buffer. Sounds positive.
Definitely. And the rating agencies agree. AM Best and Fitch both upgraded their outlook to positive recently.
What reasons did they give?
They cited the significant underwriting improvement we've been talking about and the overall strength of our balance sheet. It's external validation of the turnaround story.
Right. Now, you mentioned something earlier about off-balance sheet value. That sounded intriguing.
Yeah, this is really interesting. They talked about their 3 remaining consolidated MGAs. The carrying value on SiriusPoint's books is $83 million. But those MGAs generated $45 million in net service fee income over the last 12 months.
Wait, $45 million income on an $83 million carrying value?
Exactly. That implies an earnings multiple of, just over 2x, maybe less than 2x, actually. Now, compare that to market multiples for successful MGAs, which are often well into the double digits.
So The argument is there's potentially significant value there that isn't reflected in the current book value.
That's the idea, a sort of hidden asset that the market might be overlooking. It's a potential source of future value realization.
Very interesting angle. And quickly, they also touched on people and culture. Employee engagement.
They did, yeah. Mentioned strong survey results, a big jump in their internal net promoter score, up 16 points, and lower staff turnover.
Why is that important for an insurer?
Well, in a business built on expertise and relationships, having a stable, engaged workforce is huge. It likely helps with consistency, client service, retaining talent. You could argue it's a key ingredient for executing their strategy successfully long-term.
Good point. People are key. Okay, so strong results internally. How does this stack up against the wider market?
Well, SiriusPoint has been significantly outperforming. Just look at the stock returns. Last month, SPNT was up 4.8%, while the main insurance ETF, IAK, was actually down 2.3%.
Okay, quite a gap.
And it gets wider. Last quarter, SPNT up 16.7%, IAK down 2.3%, again, over the full year. SPNT up a huge 34.1%, while IAK managed only about 10%.
Wow. So definite market outperformance. Any recent catalyst besides the earnings?
Yeah, just a couple of weeks before the earnings call, B. Riley initiated coverage with a buy rating and a $24 price target. That gave the stock a bit of a lift, about 3%, even before these strong results came out.
Okay, so analysts are starting to notice too. What's the broader environment like for insurers right now?
Generally, commercial P&C pricing is still firm, though maybe the rate increases are moderating a bit. Reinsurers have benefited from those higher rates and, at least so far this year, relatively lower catastrophe losses globally. AM Best still has a stable outlook on global reinsurance.
So a decent backdrop. But what makes SiriusPoint stand out compared to its peers in this environment?
It really comes back to that margin momentum and capital discipline management keeps highlighting. Their consistent combined ratio improvement, that steady GWP growth, it puts them ahead of the pack, the peer median, on those key metrics.
And it ties into that transformation story since the 2021 merger?
Exactly. They've been actively pruning the less profitable, older stuff, legacy runoff, and deliberately shifting capital into these higher margin specialty areas, often using that MGA model we discussed. It's a very active reshaping of the portfolio.
Let's dive a bit deeper into those strategic growth areas. You mentioned accident and health as a volatility shock absorber. How does that work?
Right. A&H is typically short-tail business, meaning claims get reported and paid relatively quickly, usually within maybe 2 or 3 years.
Okay. Unlike some liability lines that can drag on for decades.
Precisely. That shorter feedback loop gives them quicker confirmation of how that business is actually performing. It provides a more stable earnings stream that can help offset potential volatility from longer tail lines or catastrophe risks elsewhere in the portfolio. It gives them a bit more confidence, perhaps, to take calculated risks in other areas.
Interesting. And what about casualty lines? Those can be tricky.
They seem very cautious there, which is probably smart given current loss trends in some areas. They mentioned being disciplined, reallocating capital away from less attractive casualty lines like exiting commercial auto in some spots towards better opportunities. It's active portfolio management.
And property. Growing, but managing risk.
Yeah, property growth seems focused often to those London-based MGAs and partnerships. The emphasis is on diversification and being really tight on managing their exposure to specific perils like hurricanes or earthquakes. They don't want too much concentration.
Makes sense. Okay, looking ahead then, what should we be watching for? Near-term catalysts.
Well, the Q3 renewal season pricing will be important to watch, see if rates hold up. There's talk of a potential investor day, which could bring updates on capital return plans, buybacks, maybe dividends down the line.
A dividend would be a big signal.
It would. Also, keep an eye on growth in fee income from the MGAs. They hinted at additional partnerships under advanced discussion.
And longer term, what's the big picture they're painting?
The goal seems to be hitting a best-in-class, sub-90% core combined ratio consistently and sustaining that mid-teens RE through 2026.
Yeah.
They talk about using tech and analytics more in underwriting to help get there.
Any other potential upside factors?
Well, there's a new chief risk officer, Andrew Pride, starting in September 2025. Smooth transitions are always good. Continued buybacks could support the share price. And maybe, just maybe, that dividend reinstatement we mentioned. Key milestones are always the January 1st treaty renewals for reinsurance and how they navigate next year's cat season.
Okay, lots to track. Now, before we wrap, time for our not financial advice segment. Let's be crystal clear. This is purely for discussion, maybe a bit of fun. It is absolutely not financial advice.
Cannot stress that enough. Do your own homework. Talk to a professional. This is just us thinking out loud based on the call.
Right. So with that massive disclaimer,
Yep.
What's an outrageous but plausible trade idea based on SiriusPoint?
Okay, here's the thesis. Management is executing. The numbers are consistently good. They have clear targets like sub 90% combined ratio, mid-teens ROE, and yet the market might still be underappreciating this turnaround, especially that hidden MGA value we talked about.
The 2x earnings multiple thing.
Exactly. That seems like a mispricing compared to industry norms for good MGAs.
Yeah.
So the outrageous but plausible idea hinges on that value getting recognized and continued execution.
So what's the trade?
Well, the straightforward, maybe less outrageous part. A long position in the common stock, SPNT. Betting on continued strong performance and the valuation catching up to peers, it currently trades around 1.0x tangible book. Peers are often closer to 1.2x or more.
Okay, long stock. What about something a bit more leveraged?
All right, for higher leverage, maybe consider longer dated call options. Perhaps looking out to January 2026, strikes like $22.50 since driven 25.
So betting the stock will be significantly above those levels by then.
Right. A call option gives you the right, not the obligation, to buy at that strike price. It magnifies gains if you're right about the direction, but also risk. We did see some action in the August $20 calls right after earnings, which suggests some traders were already betting on further upside.
And the catalysts for that kind of move.
Things like a positive investor day, maybe news on capital returns like that dividend, strong Jan 1 renewals, hitting their targets, plus that Program Insurer of the Year award adds to the positive story. It all relies on management keeping the momentum going and unlocking that MGA value.
Interesting idea. Again, not advice, just brainstorming.
Absolutely.
Okay, so wrapping up this deep dive on SiriusPoint's Q2, key takeaways. A really strong quarter. Clear evidence of disciplined underwriting paying off, that impressive 17% ROE, and some smart strategic growth, especially with the MGAs. Looks like they're well positioned.
Yeah, it was a solid report. And I guess the big question it leaves is, how much of this turnaround story, including that potential hidden MGA value, is actually reflected in the stock price already? Have investors fully bought in yet, especially given they keep beating their own ROE targets?
Definitely some food for thought there. Thanks for joining us on the deep dive. We hope breaking down this earnings call was helpful. Catch you next time for another deep dive.